Welcome back. You're watching WealthQuest, the show that navigates the tricky world of fund management. If you'd like to comment on the show, please do email your questions or suggestions through to us. WealthQuest@abn360.com is the email address. You can go to www.abndigital.com, and that's for more views from past shows and, of course, Quibby's blog. We're still talking about scenarios for both the South African and global economies with my special guest, Clem Santa, and, of course, my two guest hosts, Quibby and Roland. Let's move on to the third scenario, Quibby. It's called New Bulls Please. It's got a probability of 10%. How does this fit into the matrix we've been looking at?
Let's throw that to Clem immediately. New Bulls Please. 10% scenario probability
it's where
there.
we're all wrong. Ben Bernanke with his cheap money policy was right. The US goes into a full-scale recovery next year, drags the whole world up with it. So what are the flags? Well, we asked a few American economists. They said 7% unemployment in the US. If it goes below 7%, that would suggest that the US is in a full recovery. And the second flag, they said, is how the US handles the fiscal cliff in February next year. Is it going to be automatically implemented, in which case that's not a good flag, or is Congress actually going to put a deal together and implement it, in which case it is a very good flag. So you watch those two. You watch the unemployment rate, the jobs report every month, and obviously we'll watch what happens after the election in terms of whether Congress will get its act together. But at the moment, we're on 10% for New Bulls Please.
Very exciting times because so many uncertainties which could swing this in either way. So take us through some of the graphs which relate to this.
Okay, well, let's look at the four quadrants again of the four scenarios, and there you can see New Bulls Please right on the right-hand top side. It's got to do with one world, and it's got to do with high economic growth. And as Clem said just now, 10% scenario over there. I mean, one thing that Clem spoke about quite a little bit earlier on, was the whole thing around Chinese growth. And if you just have a look quickly at what Chinese growth is going to, or the population and growth numbers are going to look like. There you can see the one-child policy right at the bottom end, kind of, and you can see how that's starting to kind of make an impact as far as their demographic profile is concerned. By the time 2020 comes around, you can see how the young folk kind of starts creeping up. And they're going to have to become a lot more open as far as other societies and letting them into this country in order to kind of make sure that they have a population pyramid, not a funnel at the end of the day. The question, though, is how does one invest in a New Bulls Please scenario? Well, there's a whole bunch of companies that have been thinking about a New Bulls Please scenario. And The Economist creates an index which they call the Senior Dependency Index. This is a market cap weighted index of American corporations, but weighted by the amount of earnings they actually make out of China. Here they rebase that index to 2009, and you can see how fantastically well that is done relative to the S&P 500 index. If I show you what the valuations look like for some of those, there you can see the companies. Intel right at the top, Apple, IBM, General Electric, and you can see some of the other ones kind of going all the way down. And there you can see the price to earnings ratios and again the dividend yields for them. In some cases, it still allows you to be a dog whisperer here because it allows you the opportunity to still buy cheap, fundamentally cheap businesses, and you're getting all this Chinese growth as well.
So what does a ballsy fox do? Tell us, Quibby.
So the ballsy fox, there you can see the ballsy fox. You can see all the other scenarios that we painted earlier on from a time perspective. But if you were a ballsy fox, again, you'd own equities locally, you'd own equities globally. And there you can see, again, lots of cash and bonds in the middle where you're going to be spending as far as the cycle is concerned. I mean, the interesting thing, I think, for the South African holding is the South African holding swells slightly, and then it becomes more resource-focused. So you kind of own resources, because that's obviously you'd get a lot of demand pull as far as that's concerned.
Why do you have so much cash in this allocation, given that everything's doing well? Shouldn't you want to take a bit more risk? And if there's an inflation fear, because Ben Bernanke's printing too much money, but it sort of gets into the system, shouldn't you have some gold or some kind of inflation hedging asset, maybe?
Yeah, look, I mean, that's the whole point of this methodology is to actually arrive at what you consider the optimum allocation of asset types is for each scenario. So yes, a more ballsy fox would say you should put 80 to 90% of your money into the equity market, but then you're beginning to look like a hedgehog. You know, you've always got to bear in mind that we will probably never give a 100% probability to a scenario.
Sure.
And therefore you have to actually play in the strategies of the other scenarios when you decide what you're going to invest.
I think the interesting thing is when we built these asset allocations, we kind of looked at the major asset classes rather than trying to look at all the derivatives of the various asset classes. And then we also looked at it relative to them from a Regulation 28 perspective. We said, Regulation 28, what does that look like, and can we play within the confines as far as that's concerned? Clem, maybe it's worthwhile taking us through the last scenario.
Yeah, well, the last scenario is the one we all dread. It's called fork lightning. It's where you have a crash, you have a recovery, and then you have a second crash, which is even bigger than the first one. And 1932 was exactly what happened, because 29, the market went down, and then in 30 and 31, it recovered on Wall Street, and then in 1932, it seriously crashed. It went down to 11% of its peak value. And yeah, I mean, in that scenario, there's going to be another very uncomfortable time in the market. What are our flags for that scenario? Well, essentially there are two. One is a sudden jump in the 10-year US Treasury bond rate to say 5%. So it's seen in the same light as Italy or Spain. That is America. But yeah, I mean, it would require some serious irresponsible policies to drive American bond rates up to 5%, but there is a possibility that there'll be paralysis next year. The second thing, which is much more likely, is a default by Italy or Spain, because that then will cause a freeze in the European monetary system. And obviously the interest rates on those bonds, if it goes beyond 7% on Italian and Spanish bonds, you've got to raise the probability of a genuine default. And yeah, then it would be a financial panic like we had in 2008, and markets would go down again. And at the moment, because of what's going on in Spain particularly, we give it a 20% probability, which is high.
So basically, we've got 1 minute to wrap this up. And I just want Clem to explain to us how Fox thinks, because you also say that it's not about, you know, one strategy versus another, how Fox might be able to take all these scenarios together and in fact pick and choose, you know, how they're going to look at the world as a whole and invest their money. So to take us through what this all means for Fox investing.
What Foxy investing means is that you look at these four scenarios at the same time. You look at all the flags relating to the different scenarios. You change the probabilities. The whole point of being a fox is it's the fact that you respond to the changes in the environment. So for a fox, you're never going to make as much money as a hedgehog who bets on the right horse. But you're never going to lose as much money if you bet on the wrong horse. What a fox does is it tries to encapsulate the best strategy given the probabilities, rather than saying, I'm going to bet on ultraviolet, or I'm going to bet on new balls, please. You kind of work out a strategy that your wealth will be protected for those scenarios, but at the same time you're not going to lose out at the opportunities provided by the more optimistic scenarios. That's what Foxy means.